Welcome to the Invest for More Real Estate Podcast. My name is Mark Ferguson, and I am your host. I'm a house flipper. I flip 10 to 15 houses a year. I own 13 rental properties with a goal to buy 100 by 2023. I'm also a real estate agent. I've been licensed since '01. I run a team of 9. We sell close to 200 houses a year. So on this show, we like to interview house flippers, landlords, and the best real estate agents in the business. So stay tuned for some great shows. If you want more information on my rentals, on the numbers, how I buy properties, check out investformore.com. Hey everyone, it's Mark Ferguson with Invest for More, and welcome to another episode of the Invest for More Real Estate Podcast. I have another great guest for this week's show, Lane Kawaoka. He told me exactly how to pronounce it, so hopefully I got it right. He is from Seattle, a full-time engineer in the area, but he's also been investing in rental properties and buying some turnkey properties, non-turnkeys. He invested in Seattle. So love to hear his story, how he invests while also being a full-time, W-2 worker, and then how the market in Seattle is. For some reason, we have a lot of people in Seattle on this show, Lane, but I'm glad to have another one. So how are you doing today?
I'm doing good, and my bio's a little old there. I just moved to Hawaii a couple of weeks ago. So,
okay. Well, that's not a bad place to move. Cool. Well, no, thank you for doing the show. I appreciate it. First off, I just love to hear how you first got started in real estate. Is it something you always wanted to do, or was it, just ways to invest better? How'd that bug get into your system?
So I graduated college in University of Washington about 10 years ago. And I went to work for, I got an engineering degree, and I was following that linear path of go study hard, get a good job, and then save money to get a primary residence, because that's the only way you create wealth, right? Getting your primary residence. So I was able to do that pretty quickly because I was like really cheap and frugal and not buying the latte every day and doing all that kind of nonsense. And then I saved for that primary residence. Because I was traveling all the time for work, I was never home. So I decided to rent it out on a whim. And the rest was history. I bought the A-class rental that was $350,000 for $80,000 down. And it rented for $2,200. And the mortgage was $1,600. So at the time in 2009, 2010, it just, there was a huge gap in how much I was making for cash flow. And then at that point, I decided to get educated and then went off to do a lot different things after that.
Very cool. No, it's interesting how people get started. There's so many different stories. And yeah, I actually went to the University of Colorado, and my first year was in engineering, but I ended up switching to business. But, in college, they don't teach you anything but that same route. Go get a job, save money, put it in an IRA or 401k and hopefully retire someday. But there's so many different ways to do it. That's cool to see how a primary residence turned into a rental, though. How long did that take after you bought that primary residence before it became a rental?
Probably about a year or so. Like I said, I was traveling all the time for work. I was only home on like Saturdays. It just didn't make sense. And, it was probably the nicest place I've lived up to date. After that, I picked more of a minimalist lifestyle, trying to get off that hamster wheel of nice things and big places to live and big mortgages, and just been focusing on building my cash flow and, buying rental properties. So after that, I got educated, read the books, did all the podcasts. And then instead of buying an A-class rental in Seattle, I bought a B-plus rental duplex in Seattle. And, the numbers on that one were, I bought it for $250,000, and that rented out for I think that was about little under $2,000. So the numbers made sense at the time. And that was about 2012-ish.
Yeah, that's a much better number than the other one. But at the same time, your first investment isn't always the best one. A lot of times it teaches us more than anything else. I know Seattle has been an absolutely crazy market. What do you think that duplex is worth right now?
Oh, that duplex, I sold that thing a few years ago, but it's probably worth about 350, 400 maybe. even now. It's just
Yeah.
ridiculous. And it'd be still bringing in maybe a couple hundred more dollars in rent. I mean, the rents just aren't keeping up with the rate of appreciation.
No, that's interesting because I'm in Colorado and our market is almost exactly the same, where prices have doubled, since 2011 or more in some areas, but rents have gone up like 20%. So yeah, it's the same thing where you could buy awesome rentals, get great cash flow, and now they don't exist here anymore. And I
Right.
know you going through that in your market, it forced you to change strategies for rentals. So how did that happen?
Yeah, so about 2012, I was all in this all my money went to down payments and I was ready to buy that third rental property. But 2012, that was the time when the appreciation started to hit in Seattle, and I learned about this difference between cash flow and appreciation. And you read about this all the time in the forums. It's the great Star Wars discussion that's happening, and no one's ever right on this one. Whether you invest for cash flow or appreciation. But I wasn't cash flowing anymore in Seattle, and I was kind of spoiled at that point. So it made me pivot to a lot of different things. I tried to go to the auctions because maybe I was gonna pick up a little bit more distressed property, do a little bit more work on my end, looking for like a C plus property, like how they say that there's the A, B, and C class properties. So moving down on that spectrum to get a little more cash flow, but it just I just saw a whole bunch of unsophisticated Microsoft and other tech companies, computer programmers outbidding each other at those auctions, and I just saw how unsophisticated and how much money people had, and they just didn't know what they didn't know. And I just needed to get away from that competition or frenzy, even in 2012. So I bought a turnkey rental in Birmingham just to test the concept. I think it was about $70,000 at the time, and I brought in about 850 for monthly rent, and just to test the concept, and it worked. And then I sold all my Seattle rentals. And then on my website, I have this article about how I sold 2 rentals for 9 rentals out of state in 1031 exchanges that I did. But yeah, that I jumped right into cash flow investing as opposed to appreciation investing.
Yeah, no, I follow almost the same strategy as you. I kind of in 2015 I bought my last residential rental in Colorado, and I saw myself going kind of from like B class to C class. I kept buying, worse and worse properties to make the numbers work, and I'm like, this is just not smart. Yes, the appreciation's awesome, but you don't see any appreciation unless you sell or refinance or exchange them, like you said. Whereas the cash flow comes in all the time. And I bought a turnkey in Cleveland, and I'm looking to maybe buy some more turnkeys or invest out of state as well. But that's crazy, the similarities between our markets and stories. On the house in Birmingham, has there been any appreciation in that area, or is it just kind of a straight cash flow play?
Straight cash flow player. You're not going to see any really huge appreciation in Birmingham. I mean, you might have. I mean, I currently have 11 of these things, and you might have a few of them that'll have a little nice appreciation, but definitely nothing across the board. It's all based on the way I see it. It's kind of like stacking your chips up in like a craps table. I mean, you don't know which area, which metropolitan area will pop. And I don't know. I mean, you can look at all the data and all the stuff on the internet and talk to brokers, talk to people in the area. But at the end of the day, it's all appreciation is always like gambling. You never know. The only thing that's for sure is the cash flow, and that I knew that. I knew for me, my goal was to build up passive streams of income, and I realized that if needed cash flow, I needed to forego the appreciation because you can't have both.
Right. I think you can get both, but like you said, you kind of have to be lucky. It's really hard to predict, when the market's going to boom. I don't think anybody around here thought our market would increase like it has. And, there were some signs it would increase some, but you just couldn't predict what it would do overall. And right now, in today's, it's also easier after a crash too, when prices are down to cash flow and get appreciation, but it's a lot different market now. You bought some turnkeys and you also bought some properties kind of on your own out of state. Is that right?
Right. I mean, there's several ways you can buy these turnkey rentals. I mean, you can go through a marketer, and they're pretty obvious. You go on Bigger Pockets, and everybody's got their turnkey keyword search on. All the guys who are the marketers who refer you out to the turnkey providers and pick up referral checks here and there. But you can also buy straight from the turnkey provider. And there's that hybrid way that I kind of graduated to, which is using my own agents to kind of do the process for me. But you can only do that after you've bought probably about a few properties to know what you don't know, and kind of guide yourself down the route. But those are the three ways of buying it. The marketers do, they kind of walk your hand, but they don't have fiduciary responsibility to you, and a lot of times they're in cahoots with the provider. And of course, going straight to the provider, you're working with the real estate professional. You have no representation, so you're signing their contracts, and it really is buyer beware. And you should be educated before you do that too.
Yes, for sure. And I did my turnkey. I've seen some other turnkey companies. There's some good ones out there. There's some bad ones, and there's a lot right now. It seems like that's kind of the in thing to be as a turnkey company. So you definitely have to do your due diligence and research as much as you can. You can't just go in there blindly trusting a company will do everything right. Do you have any tips or tricks on exactly how, you were making sure the turnkey company you're working with was good, or making sure the property was decent?
I guess you just got to understand how the market is these days. I mean, in 2014, 15, 16, I mean, it was less of a seller's market, and there were a lot more turnkey inventory out there. I mean, right now, a lot of these turnkey providers, it just makes more sense for them to flip a house to retail and not screw around with us, cheapo investors who are always trying to find the deal, right? And then I feel like all the investors that I've been talking to lately, trying to get into the game, they've kind of got this entitled mentality. They're looking for that 1% in a good area. And I'm like, dude, you don't know what you don't know. And it seems like if there's a good turnkey provider out there that a lot of people are using as recommending and had good experience, nowadays they have the pick of the litter. They have hundreds and hundreds of turnkey providers, new ones that don't know anything, and they're always trying to play this size up game, because I mean, they're trying to find that unsuspecting out of state investor. And not to pick on California, but once you hear someone's from California, the dollar signs start to line up, and you don't know what you don't know, so you don't know what to ask for when you go through due diligence. You don't know what to what's normal. I mean, all you know is 1%, but you don't know what's baked into that 1%. I mean, a lot of the rehabs are going a little lighter. I mean, it's just the economics. So, I mean, what I would do is just talk to a whole bunch of investors that have bought properties and are willing to mentor you, or give you advice here or there. I mean, it's just hard in the seller's market to jump into it.
Yeah, no, it is tough. And I think the whole idea of turnkey, you touched on something really important, was just, why these turnkey companies or investors offering turnkey properties don't just flip the properties themselves, because, that's what I do. I'm not offering turnkey properties here. I just flip them to a retail buyer because they pay more money for it. I guess the advantage for the turnkey companies, they don't have to pay real estate agents, which saves a little bit of money. But as an investor who's looking to buy a turnkey property, you're not going to get a smoking deal, because like you said, they could just sell it on the retail market and make more money rather than give you an amazing deal. So you do pay a premium for having it repaired, having it rented, having a property manager. There's that turnkey company needs extra money to go the extra mile to put all that in place. So it's not an investment where, you're buying it 20% below market and you got an awesome renter and it's repaired and it's just magic investment. So there's definitely pros and cons to it.
Right. I mean, I'd say if you're buying from one of the top turnkey providers, you're probably paying 105, 110% of what the thing is actually worth. And, one thing, so you definitely don't get screwed off the bat, is never buy cash. Because I mean, that's kind of a trick that these guys get you to buy properties without that appraisal. So you don't know how much they're screwing you for.
Yes.
So always get an appraisal, always run it through like a normal real estate transaction. And always try and get that third party, uninterested party to on your behalf to tell you, hey, is this the property that's just in the wrong area? I mean, a lot of people will email me and send me properties and say, hey, I'm looking to pick this rental up, and it's always a $60,000 property that rents for 800. So automatically they're like, okay, cool, check the box on the 1%, right? This is awesome. But I'm like, in this day with where the market it is everywhere, it doesn't matter which market you are. If you're renting a property for less than $800 and it's a turnkey property that you didn't no work for and someone's bringing to you, I am 90% sure that that property is a war zone property and you don't want anything to do with that. Whether it's just in a bad part of town, it's gone through all the other local investors and nobody wants it. It just has passed through all these other investors, and you just don't want that property, or it's next to a couple blighted homes, and once you buy it, it'll be a target for vandalism. And it's just very difficult being an out-of-state investor these days. But that's the doom and gloom, right? I don't want to be the doom and gloom guy. I mean, you're still going to make probably about 15 to 25% if you do it right, which is way better than the stock market. It's not the 25 to 30% that we were making a few years ago every year, but it's still better than the other alternative out there.
Yeah, no, and those are some more great points where, yeah, if you're buying a property for $50,000 or even $40,000 and it rents for, $500-$600, maybe even more, those are great numbers. But, yeah, you need to make sure the property's not really worth $20,000 or $15,000, because there are areas like that across the country where you can get numbers like that. But then you're dealing with tenants who are being evicted every 6 months or aren't paying rent or destroying the properties all the time. And then the other thing to consider too is if you're buying properties that cheap now, you're probably never going to be able to finance it, because banks don't want to finance properties that are worth less than $50,000. They just don't want to do it. So if you're planning to pay cash now and maybe finance in the future, it's going to be impossible. And that's kind of why I've always liked that, $80,000 to $120,000 property where it's easier to finance. Usually you've got, depending on your market, a little higher quality tenants and just a better overall property.
Right, I'm the exact same way. For me, it's properties that rent for more than $900 a month. That's what I try and look for. But these rental properties are not for everybody. I mean, I talk a lot about multifamily syndication these days. That's where I'm going personally. Everybody says multifamily is the better way to go, and it is. But the turnkey rental or the single family home or the small duplex, quadplex, that's the prerequisite to do bigger and better things. I mean, for a lot of unaccredited investors, that's the way of becoming a sophisticated in the eyes of a deal sponsor. So that's how you can get your stars there to get up to bigger deals. But you should learn how this business is done. I mean, a lot of people have spouses, and can you really look them in the face and tell them you're a sophisticated investor and putting 50 grand into this deal or that deal without doing it on your own for a couple properties?
Yeah, nope. I totally agree with you there. And yeah, there's a lot of ways to get yourself in trouble in this business. But so tell me more about when you were buying properties. Kind of, I think it's an interesting strategy where maybe you buy a couple from a turnkey company, learn the market, and then say, okay, maybe I don't need to use this turnkey anymore. I can go to that same market and do this myself. Yeah. How did that process work in finding an agent? Did you have to find a contractor? Did you have to find a property manager? How was all that put together?
I think the agent and the contractors, they're a lot more plentiful out there. So it's more about you becoming educated and being able to go through the process. I mean, your first transaction will always be the hardest because you'll have to get your lender on board. You'll have to get the property. You'll have to vet the area, remotely. You have to, build the team. But once you get your team, I mean, once you get a relationship with that property manager is probably the most important person. I mean, you're off and rolling, and now you have people that are, you can consult and who are looking out for your best interest. That's why I never say don't never go with the turnkey provider's property management company. I mean, it's just too much power for the property management company, and you need to be building connections and building your network within that market. And by hiring a third party property management company who knows your property and knows who who you are personally, and is looking out for your best interests in a future transaction. I mean, that's really the best way to go. I mean, when I pick up a property or looking for, to pick up a property in, like, one of my areas like Birmingham, Atlanta, Indianapolis, that's the first person I go to. I just shoot over the address and I say, hey man, like, I got a guy, he's looking for a property. You'll probably you'll probably be the guy to manage it here in the next month or two. What do you think about it? That's the first line of defense. And then
Do
after
you
that, finding an agent and a contractor. I mean, those are kind of the easy ones. Just plugging into networks. And I've built out a pretty big Facebook group for individual markets like Birmingham, Chicago, Indianapolis. So, talking with other investors and seeing who they're using and using the group think model.
Cool. Very cool. So yeah, I was going to say, so you're pretty much saying the first person you should find is a property manager, and they can kind of give you guidance about different areas, rents, and then figure it out the other team members from there.
Right, but build a relationship with the property manager, and don't only just hit them up for random questions here and there. Actually, put them on your team and have them manage your property. Give them the business.
No, that's great advice, and I like that because yeah, like you said, the turnkey provider can tell you anything they want about a property. Agents, I'm sure you run to agents who say they know about investments, but maybe they don't know what actual rents are or what repairs might cost because they don't deal with it. But when you're talking to a property manager, they're the ones renting it. They're repairing properties as well sometimes. So they might have more knowledge than the agents in property and turnkey providers.
Right, right. I mean, it's just building your network is your net worth. And I didn't realize that in the beginning, but as I moved to different projects, and I mean, that's just that social capital that you build in the beginning. I mean, you just seem to draw upon it and as you move along, and always be looking to add value to all these people. Don't just be taking, or I call them ask holes. Don't be an asshole. Always add value first.
So what's your plan now? You said, are you still buying single family rentals? Do you plan to buy more, or are you just trying to look at the multifamily right now?
Yeah, so I hit my you can only get 10 properties right now. That's your Fannie Mae limit. So once you hit that, you're effectively Fannie Mae out. So, I haven't bought a single family home in like a year or two. I've been mostly focusing on building my network in the multifamily space, and pretty much starting from scratch and relearning. So, joining the apartment mentoring group, and running around in different syndication circles. And for me, it was, it came down to my goals. I mean, because I'm only 32 now, I wanted to do real estate and bring other people along on the ride, and have them invest in my deals in the future. So I made the jump to something bigger and better. And another distinction that, when people call me, and I always ask them, how much do you make and what are your expenses, so we can figure out how much do you net at the end of the year. And if that number that you net at the end of the year is higher than $30,000 or $40,000, I mean, you probably should be doing syndications as your primary investment. And if you haven't done any investing, you should probably focus on getting a few rentals under your belt and making the jump as soon as possible. Because, I mean, you don't want to be like me and have, double digit single family homes, and you did all this work to get one single family home for what? Just a couple $100 of cash flow. I mean, it's just not scalable. I mean, you get 20 of these houses times $200, you're only making $4,000 of passive income. And you've got all these headaches. I mean, that was something about a year and a half ago that I was looking around for. I mean, who are the mentors out there, or the people who have done it that have 20, 30, 50 houses? And they're just not out there. They're usually like the older guy who, he hasn't quite got it. He has a lot of passive income. He's got a lot of net worth, but he's been doing it for years, and they're just a tired person. I mean, the syndication route, going together with other investors and teaming up, seems to be a lot more scalable. Yeah, you're not getting 25 to 30% returns, but you're right around 20% IRRs, but it's infinitely scalable. And you get better diversification, and you get your time back, which, after you get to that 4,000 plus cash flow level, and you start looking at life a little differently. You start valuing your time a little bit more, and And that's a way to scale up and go bigger and save time and actually live your life and not being managing a property manager.
Right. Are you finding deals that can be syndicated now? I know from what I hear, it's really tough right now with our market and multifamily.
Yeah, so I mean that's a lot of people will say on the forums, but that's kind of just surface level. They'll say multifamily has passed its cycle, or they'll say about commercial has passed its cycle. I don't really believe in that because the people who are doing deals and syndicating deals, they're looking for needles in the haystack. So it really is market independent. They're buying deals that are cash flowing at high single digits, but they're incredibly undervalued. Like the rents are like $150 under market. There's all these things in the property that you can bump up the NOI and decrease expenses and increase income. So, and that's how these syndications are done. They buy these properties that are stabilized and working, but when they increase the value, they can usually double the investor's money in 5 years and out and reposition another property. But I mean, in this market, I want to go after non-recourse loans, which are 90% are occupied typically in these markets. So none of this 70% occupied or 30% occupied. Yeah, you can get a good deal, but it's a recourse loan. So if anything happens, they're coming after your personal balance sheet and everybody else that signed up for the loan. They're coming after everybody to repay that. Whereas a non-recourse loan, I mean, that's what made me jump into multifamily is the non-recourse loan for Fannie or Freddie. The government wants workforce housing and they're subsidizing that with these loans. So these are the best loans and they're non-recourse.
What kind of terms are you seeing on those loans as far as like length of the loan, amortization rates, things like that?
So usually we try to look for the 10-year note. If you think of market cycles, we're probably up on the high end. So what you don't want is that 5-year term because that's probably going to put you time to refinance or re-up for the loan when we're in the bottom of the cycle, probably. But at least a 10-year bridge will get you over to at least, it'll probably span the next correction. I'm pretty confident about that. So that's one of the big things is that length of term and then interest rates are probably about 5%. And then a lot of the government subsidized loans, it's they'll kick in the rehab money and make that interest only. So very favorable terms, but the biggest thing is that it's non-recourse debt.
Right. Cool. And are you looking for, smaller projects, 10 and 20 units? Are you looking for 100-unit projects? What kind of projects are you guys focusing on?
So I am not an extremely experienced investor in this space yet. So anything above 200 units, 250 units, I can't really touch. I mean, I can bring in partners and I have partners to go after those properties. But my sweet spot right now is this 60 to 150 units. And I think that's probably one of the biggest mistakes I see out there from investors is, people have this thought process that they're going to get duplex, quadplex, 8plex, 16plex, 32plex. But usually that's what everybody else is doing, and you want to try and stay away with what everybody else is doing. A lot of unsophisticated buyers, yeah, they've been doing this for a couple of decades, but they're unsophisticated for that reason, and you're going to be competing with these people. And I mean, I have firsthand knowledge of that. I've been looking at these properties, and I just see these properties under 60 units that are just the pricing is just worse because there's so much more unsophisticated buyers out there pushing the price up. And not to mention, of course, we all know, once you hit 60 units, you can put a full-time property management there, and you start to get economies of scale. But yeah, for a lot of reasons, 6 units and above. But the problem there is you've got to raise a little bit more money, a lot more money than a few guys can come together and do a little JV on. So inherently, we always, in our group, we always talk about, these barriers and these obstacles. These are good things for us because that keeps other people away. It's someone else sees this hurdle of, hey, this 80 unit property is going to be a couple $1 million. I need to raise like 500 to a million. Me and my two other buddies don't have that much money. So that's, that's where syndication is. You can get over that hump and you can get to access these properties that are just above the reach of the other investors who can only are doing it on their own or just with a couple of partners. You can get those properties just above them, and you're still under that institutional level of $5 to $10 million that the institutions aren't coming in and just grabbing properties, kind of like how foreign investors are buying single family homes and just, paying cash and just being ridiculous with their pricing.
No, that's interesting to hear, that kind of a sweet spot where you're underneath the big, huge guys, but above most of what other people are comfortable with. And there's still some opportunity there. So very cool to hear.
I like what you're doing. Like, I mean, I feel like you and I are kind of in the same, we're in this pivot point. We've got the single family homes, but I mean, you've got the flipping business and I see that. I mean, I'm looking at your business and that's really your highest and best use. And I just don't have that built out. So I'm making a pivot to this, and not to say that anybody should start out with what you're doing or what I'm doing, but we all started the same place.
No, that's a really good point. Just that, whether it's rental properties, wholesaling, flipping, even being an agent, it's rare that you can go through a business doing the exact same thing over and over again and not have to change or adapt to the market or competition at some point. You've got to be ready to, like, I thought rentals would be awesome forever here. They're not. So you got to make changes. You got to, either buy in a different market or maybe move to flipping like I did. I was an REO agent for a while. So I sold REOs and foreclosures for banks, made a lot of money doing that. But that disappeared because foreclosures disappeared. So you've got to be ready to pivot on that side. But yeah, really good point where you can't just be stuck on one mind, one groove, and not have an open mind to doing everything, different things, or looking for different opportunities and saying, hey, if this doesn't work out, maybe I've got this in my back pocket that I could switch to later on.
Right. And I don't know if you feel the same way. I mean, not doing many deals like in your buy and hold portfolio lately, but for me, like I said, I haven't been doing much in single family in the last year and a half. And, especially because I have that my podcast, which is Simple Passive Cash Flow Podcast. It's kind of hard to tell people to buy this stuff when I'm not buying it myself. But, in the last year and a half, I've just been educating myself and trying to make that pivot, which it's just been hard. And a lot of people won't do it because it's very humbling because now you're not doing deals, you're learning and you're kind of starting all over again. And it's a different crowd of people. It's just a totally different crowd of people that you have to start from scratch again. And that's why I totally get it. It's hard to be that out-of-state investor to call in these markets, build a relationship with a property management company and realtor and contractor. I mean, I totally get it. I'm doing the same thing with multifamily. And, and that's why I can have like always add value, like always trying to see how you can help these guys out first before you ask these million of questions so you can stand out from the crowd.
Yeah, no, it's that's a really good point too. And just because I looked at buying properties in Florida myself, and just I went out there, actually found an agent, found good properties, but I never did buy anything because just kind of like the flipping stuff took off. So I'm like, well, would I rather, invest in a market I sort of know, but not that well? Or would I rather build something local where I have total control, can do everything here? And it's kind of like, you got to weigh those pros and cons, but it is tough to jump into something new and different. That's for sure. And it's hard to make that jump, but it's usually pretty exciting and fun if you can do it.
Right. And then now I've kind of got the proof of concept. So I'm looking to like sell my entire portfolio, and, people are kind of like, what the heck, man? Like, you're telling me to buy these things and you're selling your own. But I don't know, what people don't get is like, like Mark, you've got like the flipping business, your funds are better off in there. It's the highest and best use, seed money for that. And it's kind of the same thing for me. I mean, for me, I get better deal flow and that I can, place $50,000 here and here than I do with my cash flowing rentals. Yeah, it's going to suck not having that nice cushion and cash flow and that comfort of that money coming in. But I mean, you need to make a pivot, and once you get proof of concept, you just need to go. You just need to make a decision and go.
Right. And it's not like those properties haven't been beneficial for you either to be able to provide that pivot or cash flow seed money for something else. So, yeah, sometimes you're like, man, I want to keep buying rentals. I want to keep doing what I've first started the blog for was about buying rentals. And I feel because I sold a couple as well. But then it's like, man, that investment was so great. It allowed me to do so many other things. It's not like it's been a bad investment. I'm sorry I did it, but it's just kind of, you've got to be willing to change and move directions when opportunities present themselves.
Right, right. And the only reason I can do that is like comes down to network. I mean, once you talk to more people, more experienced investors and see what they're doing, new doors arise, but you won't get the access to those people. You won't be able to add value to those people until you do it yourself and you buy that first rental property. I think
Right.
it's a prerequisite.
Yep. You learn so much about the business by just doing one deal. You can't read books and figure everything out before you actually get into the business. That's for sure.
Right. So in a way, it may be worth it paying 110% for a turnkey property because it gets it started, right? And yeah, it's still like probably double, 2 times better than the stock market, especially this today's day.
Right. Yeah. No. And the turnkey companies, they make a lot of money selling to people who aren't real estate investors because they see the stock market returns versus real estate. It is, yeah, I'm not saying it's a bad investment either, but for those of us who, are used to getting really good deals and making awesome investments, it's not as good as what we're used to. But it's all relative, to what you're doing now, to how much work you can put into it, how much money you have. There's, different grades of investments for each person out there.
Right, right. And I think it comes down to the fundamental, which I call like the pyramid of cash flow. I mean, when I came out of college, and probably what a lot of financial planners teach you is you need to go after like the Vanguard 500 or the those index funds that are more seemingly higher risk, and then titrate your portfolio down to more bond investments or cash flow investments. But I think it's completely the opposite. I think you need to be going after cash flowing assets first. So that means get out of your California market, get out of Seattle, get out of the East Coast where you're not hitting your rent to value ratios to be able to cash flow. But go to these less known areas to get cash flow first, at least to get you to like half of your monthly expenses, like whether it's 1 to 3,000 or $4,000, like passive cash flow. And then once you get to that point, you're not operating out of scarcity mode, and you've built up your network, and you found better deals, and you can move on and graduate to bigger and better things. But for many reasons, that comfort of having that passive cash flow, I mean, it can really launch you to bigger and different projects. And I think that's just a much more prudent way of going about doing it. I mean, there's a lot of other strategies out there like land investing or fix and flipping to start out. And yeah, you'll make a lot of money, but you're always going to be going paycheck to paycheck or from deal to deal. But if you build that cash flow base first, I'd say probably about to $3,000 is for most people, and then you save up the money to do something bigger, like if you want to do a fix and flipping, or you want to go into bigger syndication deals and go for more appreciation. I think it starts with that foundation. So it really is like a triangle as opposed to what normal conventional knowledge is.
Yeah, no, that's a great point. It's so much easier to take some risks, to go out there and try something different when you've got passive income coming in, and hey, if it doesn't go right, if something happens, I still have this money. I'm not relied solely and completely on this one flip deal, So
right, yeah, and I see a lot of people
easier.
on the forums. They're saying like, don't buy these properties out in the Midwest. They'll never appreciate. That's not what I did. That's not what I'm doing. Or these other people who are land speculating. And from what I see, like the people who have a lot of cash flow, a lot of net worth already, that's what they should do. But that may not be your situation. If you're just an engineer or starting out being a lawyer or doctor, you'll get there. But you need to start with building that cash flow, because that's what kind of essentially frees you from your job. And you may still work your job, but that peace of mind knowing that if you stop working, your handful of rentals will be pulling in a few grand to be able to make the ends meet. That's so invaluable to have that peace of mind.
Oh yeah, for sure. No, it's great for me when I was doing different things and flipping. And it's wonderful to have that backup. That's for sure. Well, Lane, I think those are all the questions I had. What's the best way for people to contact you? I know you gave out your podcast. Give that out again, and any other ways for people to get in touch with you.
Yeah, so I do a podcast at Simple Passive Cash Flow. You can check it on iTunes or Google Play. Come to the website, simplepassivecashflow.com, and you sign up for my investor list or my email newsletter. You'll get access to a bunch of spreadsheets, a bunch of Google Drive where I just put a whole bunch of stuff in there, from like spreadsheets and what to ask turnkey providers. Working on a book, How to Buy a Turnkey Rental, which you guys will get for free when it comes out. And then a whole bunch of other analysis spreadsheets. So, I mean, my whole thing is to get people out of Wall Street. And I think, you and I are totally aligned with that. So whether you work with me or somebody else, I mean, I don't really care, as long as you kind of pick a different lifestyle and buy assets instead of doodads. That's all I want.
Nice. All right. Well, great information. It's really cool to hear your story and what you're doing, and how, like I've had to pivot as the market changes and our own goals and what we learn changes. Anything else you want to leave us with before we go?
No, I mean, you and I did your podcast interview on mine, and we got to know you a little better. So I'll let you know when that comes out, Mark.
Cool. Yeah, no, I'll be sure to share that with everyone on my network as well. And thank you again for doing the show. I really appreciate it. And we'll have to keep in touch for sure.
Yeah. All right. Thanks, Mark. Thanks for having me.
No problem.